Don't adjust your screen. I'm upside down for good reason. And that's because it can really help to understand how price action works on charts by turning those charts upside down. And in particular, it can help us to understand the differences between the nature of price movements for stock indices and Forex. And that's what today's session is about. What do you need to do differently when you trade stock indices compared to when you trade Forex or currency pairs? And we'll be looking at some of the fundamental differences, so stay tuned. So let's start with a quick overview of what we're going to be covering today. Firstly, we're going to be looking at the characteristics of price data. And in particular, we're going to be looking at the differences between the price action of Forex currency pairs and that of stock indices. And based on that, we'll look at what the implications are for when you approach your trading of these two different asset classes. Next, we'll move on to how you measure the alpha of your system. And by this, of course, I mean the performance of your system against an agreed benchmark. And finally, we'll sum up by looking at some of the additional considerations, including swap charges and dividends. So let's start this now by looking at some of the characteristics of currency pairs. Now here, of course, the price is actually a representation of the relative strength of two currencies, or the underlying economies that underpin those currencies. And because of this, there isn't any underlying bias in either direction, not up or down, other than, of course, the drivers from fundamental aspects such as interest rates, GDP, from those two underlying economies. And the important point here is that this means the price movements operate in a symmetric way. And because they're symmetric, this means that if you turn the chart upside down, so for example you plotted a dollar-euro chart instead of a euro-dollar chart, which is the normal way of representing this pair, then the price action would look equally viable. So this is an example of a daily chart. In this case, it's euro-dollar. And here the chart is the right way. So if the euro is strengthening compared with the dollar, then the chart's going up. And if the dollar is strengthening compared to the euro, then the price will go down. But let's now flip this on its head. So if the convention for plotting these charts was to put the dollar first, then this is exactly what the chart would look like. And if you showed this chart to any trader, they would not be able to see that there was any issue with it. It looks equally viable this way as it does the other way. So what are the implications of this? Well, firstly, it means that it's viable to have a long-short symmetric strategy that trades this pair. And by that, I mean a strategy that uses the same rules and the same parameter values when going both long and short. So as a very simple example, let's say you're using an indicator which is an oscillator which ranges from values of 0 up to 100. And if you were using this indicator to tell you when the price was oversold or overbought, then you could have a symmetric rule which said you'd buy when the value was 10 and you'd sell short when the value was 90. And there'd be nothing wrong with this approach whatsoever. And in actual fact, it would actually help with things like statistical significance during backtesting, because you'd effectively be doubling the number of trades that the system produced. And this in turn would help you to produce more robust trading strategies. So let's now turn our attention to stock indices and take a look at what the differences are here. And fundamentally, the price action is based on a completely different calculation. Here, the price of the index is a representation of the value of the component companies that make up that index. So unlike Forex, there's no relative behavior at all. And because of this difference in calculation, it means that there's also a difference in the price action dynamics, the way that the price action moves. Furthermore, there's also a bias towards prices moving in an upwards direction. And because generally only the biggest and best performing companies take part in the index, the upward slope is actually assisted by survivorship bias. And this is because as soon as any company starts to perform less well, they'll actually be removed from the index and have their place taken up by another company that's performing better. Now, history shows, of course, that stock indices continually grow, and they do, of course, sometimes experience drawdowns, and when they do, this can be extremely severe, so think of 2008. But they do always eventually return to making new highs, and it's this upwards bias that's always there with stock indices that means the price action is not symmetric. So here, if you did the same and turned a chart upside down, it wouldn't look quite right. So here you've got the Dow Jones, which is the right way up. And one of the characteristics of this chart is that every time there is a major fall in the price, this happens very rapidly and also very severely. And you can see an example of that here on the right, here again in the middle, and again here. And if you compare this to the periods of time when the price is increasing, you'll see that this happens in a much more stable and reliable way. So let's now do the same and turn this chart upside down. And if you did the same and showed this to an experienced trader, instantly they would know there was something wrong with this chart. It just does not look right. The upwards and downwards movements do not look like this in an actual trading asset. And the implications of this are that you cannot use a symmetric system that trades long and short using the same rules and parameters. It just isn't possible. At least it's definitely not recommended. So when trading stock indices like this, you need to devise different rules for your long system as opposed to your short system. Or at the very least you'll need to use different parameter values. Now what this means is that you can't optimize a long-short system together as part of the same process. Generally you'd have to both develop and backtest them and optimize them independently. And this of course also has an impact on statistical significance because generally you'll only have half as many trades. Another consideration, of course, is that traders will find it easier to build long-based systems than they do short-based systems when they're trading indices in this way. And it's fairly easy to understand why that's the case. It's just like a river. If you were paddling downstream in the direction of the flow, it would be much easier than if you were trying to paddle upstream against the flow. And it's exactly the same for stock indices. Although, of course, I do know that there are shorting specialists who do excel in shorting the stock markets. And so, of course, it is possible, it's just harder. So we've covered there some of the fundamental differences in the approach you need to take when trading Forex as compared to stock indices. In the next part, we'll be looking at how you need to measure alpha differently for each of those types of system. And we'll also be looking at some of the fundamental differences in terms of things like swap charges and also dividends. So click top right now to go to the next part.